Benvenuti, welcome. I'm Daniele Friggeri, Director and President of CESPI. Welcome to this webinar in hybrid modality. Thank you to all the speakers for accepting this to participate in this event. The idea is to transform this event as an annual gathering to take closer look to South Asia region. South Asia is a specific region that has become one of the world's demographic and economic hubs, but at the same time remains plagued by significant challenges such as economic inequalities, internal tension between the states, the role of China, vulnerability to climate change. So in 2023, CESPI chose to look at this region from a specific perspective, with the specific viewpoint that encompasses both the region's potential and the risk. Was born the Indian Observatory that was established with this main objective and perspective in mind. Today's meeting looks at the entire region, seeking to highlight the Indian's role within it. In a specific context that is marked by global instability, significant uncertainty, with the impact of the war of the Middle East that we discussed, the policies of the Trump administration, and the rapid development of new technology that have changed the geopolitical scenario and the internal labor. All variables that have and will have a significant impact on the dynamics and trajectories of development of this area. We are doing this exercise with three contributors, the World Bank, the Asian Development Bank, and the OECD, an authoritative perspective from different angles, one that seeks to provide a comprehensive picture of the region. We believe that this important opportunity, and for this reason, I would like to thank you again, our speakers, as well as Sergio Lugaresi, coordinator of the Indian Observatory, to whom I'll now give the floor.
Thank you, Daniele. Welcome to everybody. Good morning, good afternoon, wherever you are. So this is a joint presentation, as Daniele said, of three international reports. We have already done last year the presentation of joint presentation of two reports. Before we started with the Asian Development Bank, and we now, as Daniele mentioned, would like to continue with the joint presentation in order to compare and developly discuss. The three reports are the Asian Development Bank Asian Development Outlook that has been published in April, the World Bank South Asia Economic Update that has been published also in April 2026, and then the OECD Economic Outlook for Southeast Asia, China, and India that has been published in 2025. And the focus of the presentation discussion will be mainly on India, but this report, as the title say, are broader and very interesting. The speakers in alphabetical order will be Federico Bonaglia from Remote, who is Deputy Director of the OECD Development Center, a member of the steering committee of our observatory. Matteo Lanzafame, who is Director of Macroeconomics Research Division, Economic Research and Development Impact Department of the Asian Development Bank. And last but not least, Francisca Onsorge, Chief Economist, South Asia at the World. The discussant will be Siddhartha Mitra, also from Remote. He's Professor of Economics at Jadavpur University in Calcutta, and he wrote a paper on the potential impact of artificial intelligence on the economic growth of India that has been published by the CESPI Observatory on India, and you can find it on our webpage. The second speaker is Gianpaolo Ruggero, who is head of the division dealing with the global economic perspective at OECD Affairs at the Directorate General for International Financial Relations of the Italian Treasury. He had started his career in central banking, Bank of Italy and European Central Bank, and for a 2-year period has been seconded to the World Bank, and is currently hold the position of Executive Director for Italy at IFAD. Finally, we have Pasquale Scaramuzzino, who is full professor of political economy at the University of Tor Vergata in Rome, and professor emeritus at SOAS University of London. He is also member of our steering committee, of the steering committee of the observatory. So we have thought to organize the discussion in 2 rounds. The first will be focused on the macroeconomic challenges. And of course, the focus there will be mainly on the effect of the impact of the conflict in the Middle East. And the second round of preparedness and potential impact of artificial intelligence. So why don't we start with the impact of the conflict? And we start with Matteo. The ADB has published recently, after publication of the Asian Development Outlook, and a brief to update the forecast, as the first projection were based on the assumption of a temporary shock. And unfortunately, this shock is revealing to be much longer than that. So they have updated. So, of course, our interest, what are now the projection? For India, we're quite positive in ADO, like around 7% in both 26 and 27. And with inflation relatively under control of around 4. Now, what are the new projections and your assessment of the policy responses? Matteo, influence.
So thank you, Sergio, and thank you, Chesky, generally for the invitation. Hope this is working. So thanks a lot as well for attending this presentation. So Sergio was saying ADO was published on 10 April. So my presentation is going to be a mix of what we presented in the report on 10 April, but also the updates to the forecast in particular, but the analysis more generally. ADO, just very quickly, is the flagship report from the Asian Development Bank. We published in April and September, and we also have shorter supplements in July and December. So the next issue in July is going to provide a more updated analysis. So key messages, the outlook for the region is impacted quite substantially from spillovers, from the Middle East conflicts, and I'm going to tell you a lot more about this. However, the region as a whole is entering this challenging environment from a position of strength. Last year, growth was 5.4%. Inflation was coming down from the increase in inflationary pressures following the Ukraine war. So in April, our baseline scenario was for early stabilization of the conflict, roughly 1 month. By 10 April already was pretty clear that that was not materializing, and that's the reason why we updated the analysis. In our updated analysis, the baseline assumption, what we call the reference scenario, is that the conflict is going to be longer, but in particular, disruptions are going to be much more persistent than we initially thought. So there is an impact on growth, which is now projected at 4.7%, and also inflation, which is projected at 5.2% for 2026. And we also have what we call a severe downside scenario. It's really a stress test for our reference scenario to see, how much worse the impacts could be in case that we have renewed escalation. I'm going to focus mostly on this analysis. Obviously, there are other downside risks, renewed escalation of US tariffs, for example, potentially sharp tightening of global financial conditions. And so I can also talk about that during the Q&A if you want me to, but most of my presentation will focus on the Middle East. So why is this important for Asia? Asia in the global economy is probably the economic area that is mostly exposed to spillovers from the Middle East conflicts. Roughly 20% of global energy, so oil and LNG, transits through Hormuz, and 80% more or less of that ends up in Asia. So that's really a choke point for the global economy, but mostly for Asian economies as well. And you can see on the left-hand side chart here that many economies are really dependent on imports of energy globally, and as I was saying, from the Gulf. And I have highlighted there India. I think it's roughly 3% of GDP that is the weight of imported energy. But as you can see on the right-hand side, roughly 55 to 60% of that energy that is imported in India comes from the Gulf economies. So that's an important point for India as well. Another channel that we highlight in our analysis is remittances and dependence on remittances, which is really high for several economies, but in particular for some economies, this dependence on remittances from the Gulf is very significant. And on the left-hand side, you can see Nepal in particular, roughly 88% of remittances as a share of GDP come from the Gulf. On the right-hand side, if you look at the subregions, it's really South Asia that is mostly impacted, and Southeast Asia than the rest of the region. So, if the impact on economic conditions in the Middle East economies is significant, we can expect the remittances flow into Asia and these particular economies also to decline. So that's another important channel. So as I was saying, the economy in Asia is entering this period from a pretty strong point of departure, I would say. 5.4% growth last year, inflation coming down, and as you can see on the bottom panel of the right-hand side chart, that's also the case for India. Inflation was coming down up until the beginning of this year, so January, and it was driven mostly by a slowdown in food prices. And also, as you can see, core inflation is relatively stable. So the conditions before the conflict were really resilient. So our early stabilization scenario, as I was saying, by the time that we launched ADO was already outdated. And so we updated our analysis to take account of these more persistent disruptions to energy markets in general. We're going to give you at least a few reasons why we think that these disruptions are going to be persistent. Given this assumption of more persistent disruptions, our analysis shows that with respect to ADO, also the macro impacts, so the impact on growth and inflation, is going to be more persistent. There is significant heterogeneity across the different subregions. Some economies and some subregions are more exposed than others, and they're going to be impacted more strongly for a number of reasons. The energy dependency that I was mentioning before, more exposed, for example, to the spike in fertilizer prices, country-specific vulnerabilities from the balance of payments point of view, for example, and others. And then we also, we have a section where we talk about policy priorities and policy suggestions. So why do we think that this shock is going to be more persistent? Starting point is that even if you have this ceasefire that was announced on 8 April, you don't really see any improvements in transits through the Straits of Hormuz. So here I'm showing transits both inbounds and outbound, and you can clearly see that there is no return to pre-conflict levels. So, our assumption is that this is going to continue. You're going to have some recovery after the conflict is over, but at the same time, you can expect persistence in this kind of shipping disruptions. Also because of insurance costs, because of some persistence in risk premia, and so on. So that's one point. The second point is that the damage to energy facilities in the Gulf it's really going to take some time to be repaired. And that's particularly the case for LNG facilities. You can see it on the right-hand side. Roughly 17% of global production, especially in Qatar, has been impacted by the conflicts. And estimates at the moment are that it's going to take 3 to 5 years to go back to pre-conflict levels. The impact on oil facilities is smaller, around 2.5%, but still we are talking 2.5% of global supply. And it's going to take weeks to months. These are the estimates to repair it. So these disruptions are going to be persistent. If tomorrow the conflict is over, you're still going to have a problem in terms of energy supply. This is already spilling over in the region. These are diesel and gasoline prices, and in particular, changes from pre-conflict to the latest data available is 27th of April. You can clearly see that there is a spike in especially diesel prices in some economies more than doubled, 150%, for example, for now PDR. At the bottom of the table, you see changes that are very small, in particular for India, but also Indonesia, Japan. These are economies that are using fiscal resources to keep prices down or to modest increases. So short term, this is something that can be done, but at the same time is creating some fiscal strains that sooner or later are going to show up in government budgets. If you look at CPI inflation, you see a similar picture. In particular, the energy component is already increasing. In the right-hand side chart, you see it for China. It increased 7.3% in March. That's month on month. Base effects there are playing a role, but at the same time, you can clearly see that energy inflation is already increasing in the region. And you can expect this to affect the other components of CPI over time with some lag. That's particularly the case because fertilizer prices have also spiked, and these are going to impact agriculture again with a lag. More specifically for India, so I'm showing here 4 different panels. On the top left panel, there is something that I haven't mentioned, but it's going to be important for the region as a whole, but also for India in particular. There is now a much higher probability of a significant El Niño that is likely to impact, again, agricultural production this year in India and in the rest of the region. And that's going to be compounding the effects from higher fertilizer prices. In the bottom panel on the left, you can already see that fertilizer output in India has declined quite substantially from the beginning of the conflicts. On the right-hand side, the top panel, what that is showing is that inflation expectations are increasing in India. Nothing dramatic so far, but this is something that the RBI needs to take account of in terms of the policy trade-off, whether they want to hike policy rates or not. So the picture is kind of becoming clearer over time as the conflict continues, and that's also the case for oil prices and LNG prices that you can see in these 2 charts. After the initial spike, there was prices came down, but they are significantly higher than they were pre-conflict. Markets are pricing now these prolonged disruptions that I was mentioning before. These are future prices. So if you look at the bottom of the, over time, over different periods, if you look at the bottom line, those future prices on 27th of February, so the day before the beginning of the conflict, and the latest data available that we have there is 1 May. So the pattern is exactly the same. There is a spike initially, and then you see the markets are pricing a decline of these disruptions. But clearly, on 1 May, future prices are consistent with disruptions in prices being significantly higher than they were expecting back in February. So we are taking account of all this and also other disruptions. These are disruptions to non-energy commodities and commodity prices that I was mentioning before. These are connected in particular to fertilizers. Urea prices have increased more than 85% from the beginning of the conflict, ammonia 60%, and so on. Again, these are going to feed through into food prices over time. So we are taking account of all that in our updated analysis. We are adding also, shipping disruptions proportional to more or less half of what they were during COVID. We're taking account of other disruptions to financial conditions and so on. And so we built these two scenarios. The first one is the reference scenario. All of these assumptions are taken account of. On average, the scenario assumes that oil prices are going to be $96 per barrel in 2026 and 80 in 2027. So significantly higher than pre-conflict. Pre-conflict, we were around the low 60s. And the severe downside scenario, again, much higher prices. And these are the results. To answer Sergio's question, we don't have country-specific estimates in the brief. But South Asia, a lot of that is accounted for by India, and you can clearly see that for South Asia in particular, the reference scenario suggests the growth is going to be around 5.7% in 2026. That's 1.1 percentage points lower than last year, and it's 0.6 percentage points lower than in the early stabilization scenario. So for the region as a whole, growth in the reference scenario is 4.7% this year and 4.8% next year. Again, significantly lower than in 2025 in particular. And obviously, you can see that the severe scenario suggests that the impacts are going to be significantly larger if we are in that situation. And then, if you want to look at inflation numbers, again, significant spike in inflation with respect to last year, and also higher with respect to the reference, the early stabilization scenario, just because this assumes that the spike in prices is going to be much more persistent. Against this background, our recommendations from the policy point of view is mainly that policies should be targeted, it should be time-bound. It is not a good idea to implement, general broad-based policies to control prices, to provide tax cuts for fuel consumption and so on, because as I was saying before, that's costly from a fiscal point of view, but also it blunts incentives to reduce consumption of fossil fuels and, for example, increase consumption of renewables or other types of energy. From the point of view of monetary policy, this is still very much a supply-side shock. So the general and the traditional advice from central banks is not to intervene too quickly, but to wait for inflation expectations to start to change, or in the worst case scenario to be disanchored, second round effects on core inflation and so on. And finally, this should be an opportunity for economies in the region to accelerate investment in renewables and to diversify. Both because it's important from the point of view of building resilience to this kind of external shocks, but at the same time because it's a good idea in general with respect to climate change issues. And finally, we also took a look at what economies in the region are actually doing already in terms of the policy responses. And what you can see here is basically a list of different types of policy responses. So far, actually, what we see is that the kind of policies that we are suggesting have not really been picked up in several cases, and most of the intervention is really on price controls on fuel subsidies. So I think I'll leave it.
Thank you, Matteo. Very good. So yes, you didn't mention that among your suggestions there is also targeted cash transfers. Let's say an important issue for, let's say, political for economic policy and policy management. And you mentioned also Q&A. So yes, we would like to have a Q&A session at the end. So I would like to ask the speaker to try to stay to the agreed limits. And I would also encourage people that are connected from remote to post their questions in the appropriate box of Zoom. So now, Francisca, the World Bank economic update is also based, the projections, on a temporary shock. And it contains, and is focused also, interestingly, to the effect of trade reforms. We have discussed in this observatory the agreement that has been reached between the European Union and India, for example. So my question is, what are your projections? Are you updating them? Are trade reforms possible mitigation to the negative effect of the shocks? That's the second, so we can show the slides.
Thank you. Thank you very much for inviting me to this event. I'm very glad to meet my colleagues from Asia, from Manila. Also very glad for co-hosts from the Treasury. Thank you very much. Yes, I'll go through in 2 rounds. I'll go through 3 questions. First, what are growth prospects? That's the comparison, direct comparison that you suggested. And what are the risks to South Asia's growth prospects? That'll be the first batch. And then the second batch, we'll talk about AI, and we have quite a few interesting results there. So first, about the growth prospects. South Asia, there's no need for all the detailed numbers, but South Asia is really the bright spot among emerging markets in the world, actually. Because emerging markets are the bright spot in the world. So, and within emerging markets, South Asia is the bright spot. And within South Asia, it's really all about India. As you said already, Matteo, it really entered March on a really strong footing. So in South Asia in general, surprise on the upside, and India in particular, surprise on the upside. So just to give you a sense, the blue line here in the left chart shows you the India's growth versus the orange line that shows you the growth of other emerging markets and developing economies. India truly is the bright spot in the global economy. Chart on the right mostly shows you the forecast area. It really is a particularly uncertain time, which is also why we no longer use the language of baseline scenario for the left chart. It's now become, I think, globally a reference scenario, which is no longer necessarily the most likely scenario. And this we expect to continue. We expect India to remain the bright spot in the global economy. And one of the reasons we expect that is trade reform. So India is not the only one in South Asia that's putting in place trade reforms. But here I'll just talk about India now. The chart on the left refers to these trade agreements. India has really accelerated, like doubled down on all its efforts to enter trade agreements with trading partners that have long been paused, and now they've come back. So there's the EU, there's the UK, there's Oman, and there's New Zealand. And they're exploring more trade agreements. So they're really doubling down on these trade agreements. And that is a big change. And just to give you a sense of how big the change is, we have the chart on the left here. So for each country, it counts all its trading partners that it has trade agreements with, and then adds up the share of global GDP of these trade agreements, of these trading partners. So it kind of gives you a sense of the potential export market. For example, India, before the UK and the EU and Oman and New Zealand, the blue bar here in the left chart, before those agreements, India had special agreements with countries that account for 15% of global GDP. That's the blue bar. After these recent agreements, and that's not even the end of it, after the recent agreements, it's not even counting the US, it is now doubled. It is 30% of global GDP that India potentially has preferential access through these agreements. It's big. It's potentially really big. The question now becomes, can they take advantage of it? But potentially, it has doubled its external market size, courtesy in part to the EU. So thanks to the EU. Now the challenge will become using it, making the most of it. But in principle, this is big. And it makes a big difference to household incomes. This is a pro-poor household reform. So we know for each household where they work, and we know for each household what they consume. We know the consumption basket. If we now assume that these tariff cuts that are part of these agreements, that are passed through to prices, we can tell how much each household, how much each type of household benefits. And it's clearly positive. All types of households will benefit. In Sri Lanka, there are more differences. In India, it's really across the board that all households will benefit. But what is just as interesting is which firms will benefit, because that's where the vested interests are. That's where the pushback comes to these reforms. It turns out that these tariff cuts are deepest in sectors that can handle it. in these emerging export sectors, as we call it. So the chart on the left is a bit complicated. It shows you on the vertical axis the tariff cut in the EU and the UK agreements. Yes, just the EU and the UK agreements. And on the horizontal axis, it shows you for each sector India's revealed comparative advantage. So if India is far on the right, like mineral fuels, it's already super competitive. It's already exporting plenty. I mean, this is the story of the re-exports from Russian oil. No? The beauty of, at the moment, I shouldn't call it the beauty, but the convenient aspect about India's oil exports at the moment is that India's refineries can take a wide range of oils, crude oils, including Russian, including other crude oils. But they're already very competitive, they're already exporting plenty. As it happens, there are also no import tariffs in that sector. These industries are already competitive. Then if you go all the way to the left, coal mining, there are lots of tariffs on that, and it's not exporting anything. It's not a very competitive sector. So those sectors, there's not much happening in these agreements. All the action is happening in the center, in these emerging export industries. Transport equipment, chemical products, pharmaceuticals. Pharmaceuticals are far to the right, not in this chart. They're included in the chemical products, but a small part of it. Agriculture, leather products, processed foods. These industries are already exporting a little bit, but not that much. Their share of exports is not that much yet. So these industries would really benefit from a bit of competitive pressure combined with lower import tariffs. Imported input tariffs. If you drew the same chart for imported inputs, it would also turn out that these middle industries, these emerging export sectors, are the ones where imported input tariffs would also be falling most. So there's going to be a lot of churn in these middling industries, chemical products, transport, leather, processed foods. There's going to be much cheaper imported input tariffs. There's also going to be competitive pressure on the output side. That promises growth. That promises growth in this churn. Lots of disruption, but also growth. Now, of course, this outlook, even though it's better in most other countries, is subject to risks. And already Matteo spoke about, one obvious risk in the short term is the energy market disruptions. The center chart is what Matteo already showed you, the oil future prices being very high and much higher than before. The chart that may well have the longer impact, even once oil prices come down, is global financial conditions. That's what we're trying to convey with the chart on the right. It applies to the Fed policy rate. It's the probability that markets attach to Fed policy rate cuts or hikes. So until March, until the conflict erupted, markets were actually expecting 3 Fed rate cuts, because there was a nomination of the new Fed governor underway. How that's changed? The blue bar used to have a probability of like 75% that there'd be 3 cuts. That's completely changed. We're now in the red line. The 80% of the probability, markets think that the probability of rate hikes, or at least unchanged, is 80%. Nothing will happen. So no more cuts. Financial conditions are clearly going to be tighter than expected previously. And that may well be the thing that affects us next year. Even if this year we muddle through and energy prices normalize, next year these tighter financial conditions will still be with us and might actually have tightened further if, what Matteo was saying, inflation is going up. In the US as well, not just in emerging markets. Now, here Matteo already showed you variants of this. Stress, and economic stress comes through exposure and lack of policy space to respond. These are the exposure measures that Matteo already discussed. So the energy share and CPI is high, oil and gas imports are high, but as Matteo also said, there is policy space. And again, these South Asian countries are implementing a lot of subsidies because the logic is that these energy market disruptions are temporary. So we want to smooth fuel prices. fuel prices, food prices. And that's why we have these subsidies or changes in tariffs. And India has modeled tariff cuts, fuel tariff cuts to offset the rising fuel prices, an implicit subsidy. They're manageable. They're manageable because India entered this period, this conflict, with very strong buffers. So the estimates are that these fuel measures cost about 0.5 percentage point of GDP. Very manageable. They were planning to have fiscal consolidation. Okay, it'll delay the fiscal consolidation. Most of India's debt is very high, sort of 80 to 90% of GDP, but it's mostly domestic. So there's the risk of an investor run is much less. So there is policy space to buffer these. One item that Matteo only touched on that's in the news now a lot is these fertilizers. This is the second shoe that everyone expects to drop. I don't have charts on it, but obviously I'll have to do them next time. So fertilizer prices are very high, as they're up like almost doubled. For urea, urea is the thing that comes from the Gulf. Urea is the thing that is also mostly, so India produces its own, but it uses the gas that comes from the Gulf, and most of it is the gas. A large share of that gas comes from the Gulf. And you already hear stories in Bangladesh, for example, that the fertilizer plant had to shut down for extended periods because there's just no gas, not the right kind of gas, couldn't do fertilizer. And that's why everyone expects that the next harvest might well be very weak. There are mitigating factors. We need to be very clear of them. First, the next harvest is a long time away, still several months away. For now, for this harvest, there is enough fertilizer. So this harvest is proceeding as planned. The next harvest is really the crux of the matter, and that we'll know in 2-3 months, will there be enough gas? Second, even if the fertilizer is running short for the next harvest, the region produces a lot of rice. Yeah, rice and wheat are the two main crops. As it turns out, rice requires less urea than other crops, than wheat, for example. Sort of 3-to-1 ratio urea to other stuff versus 4-to-1 ratio. What rice requires more of is potash. Potash is not produced in the Gulf. Potash comes from Canada, Belarus, I think Canada and Belarus are the two main ones. Potash is not disrupted. And even within this optimal ratio, there is room to diversify between potash and urea. And you can substitute some of it. So the rice harvest that's so prominent in the region should be less affected than the wheat harvest that's much more prominent in Europe or in Africa, I believe, as well. So that's one mitigating factor. The other mitigating factor is that this is currently a bumper harvest, and even before this is being harvested, the stocks for rice especially are at record highs, historic highs. And stocks are usually designed to last for a year. So the concern about food price spikes next year are maybe a bit mitigated by these other factors. The fact that there are other fertilizers than urea that are not affected, the fact that there are large rice stocks, and the fact that there is room to switch to other types of fertilizers within reason for rice, for the main crop. But there is another thing that Matteo just touched on, is the El Nino, and that is another risk for the region. So El Nino is like an extreme case of a potential for climate disaster, but even without El Nino, the region is super exposed to climate disasters. Actually, here in the chart on the left, you see that South Asia ranks among the highest, is the highest, most vulnerable region to climate risks. About, millions of people are exposed to, here you see in the chart in the center, are exposed to flood and heat risk every year. That's every year. Yeah. So this region is incredibly exposed to flood and heat risk, and it's rising. Now, we've done a whole research program, issued a study where we've asked. So the logic is that there's a limit. Yes, governments can smooth over temporary shocks, but in the long run, really the private sector is on their own. There's a limit to how much the government can help with climate adaptation to all these risks. So what we've done is we have asked thousands of households in two parts of very flood-prone parts in Bangladesh and India. And we've asked thousands of firms in Pakistan, India, and Bangladesh how they adapt, why they adapt, and how they adapt to climate disasters in particular. Turns out that they know exactly what's coming. So their forecasts are not very different from expert forecasts. And they are adapting, and that's the point of the chart on the left. Do you adapt? Yes, 3/4 of households and firms adapt. Yeah, the chart on the left shows you households, chart in the center shows you firms. Yes, they're adapting to climate risks. The catch is in how they're adapting. So 3/4 of them are adapting. That's the any bar here in both left and center chart. How they're adapting, and that's where they're not very effective. They're adapting in these very rudimentary ways. So households are digging some ditches around the house. They're putting a threshold at the entrance so the water doesn't run straight into the living room. They are planting some trees around. Firms are buying a fan. Lots of firms are buying a fan. But where is the fan? Is it in the boss's office? Or is it on a factory floor? Is it one fan? Is it many fans? So it's this very local, and on average, they spend about 2 to 3% of revenues, the firms, on these climate adaptation measures. So yes, they're adapting, but they are adapting in very rudimentary ways. And we've done a literature review. What kind of ways are the most effective? These are not the most effective ways of adapting. So why are they not adapting in more effective ways? And that's where the old-fashioned development constraints come in. So here we've got households in the left and the center, firms in the right. Who is adapting more? Those with formal credit, access to formal credit. Those households that have more assets that they can use to adapt. Those that have access to tertiary education, or the ones with tertiary education are adopting newer technologies. They are doing less on the labor adaptation. Labor adaptation is just about the least effective form of adaptation you can do to climate. What it means is that you work at night instead of during the day, right? Because 6 to 8 hours of the day are already too hot to work outside. 40% of employment is in agriculture, so you switch from working during the day to at night. That's like the most rudimentary adaptation, and it's also the least effective in mitigating climate damage. Those with tertiary education, those who own land, need to do less of it. And firms also, it's the classic firm constraints that make all the difference to climate adaptation. Management practices, digital technology, access to access to finance, basically. So big risk, households are adapting, but it's very restricted on what they can do. And with that, I hand over to Federico.
Yes, Federico, thank you, Francisca. The mitigation measures are very important. We know as economists that the scenario is very negative, but we have to also account for reaction of the actors. So that may bring a little bit of more optimism. Federico, the OECD report has been published last year, so it doesn't. The projections are not based on the conflict, of course, but has a very interesting focus on disaster risk financing. And I think Francisca already provided some very useful information for your discussion. And in any case, we are facing now a shock that somehow is similar to a disaster. And maybe some of the tools you are analyzing in your report may be useful. Federico, the floor is yours.
Thank you, Sergio. Good morning, everyone. I am having some challenges with my screen. Can you please confirm me that you see the presentation?
No.
You don't see the presentation. So let me try something.
Okay.
You see it now? Excellent. Thank you very much. So it's a pleasure to be here with you and to complement the excellent presentation of Matteo and Francisca. What I was planning to do is the following, is to remind very quickly the nature of our outlook, explain why we believe that a focus on disaster risk financing is crucial, in particular in this moment. Very briefly go through the status of DRF, disaster risk financing in emerging Asia, with a specific focus on India, and then conclude with what we see as 4 main challenges or opportunities, if you want, for enhancing disaster risk finance. as you said, Sergio, our outlook was published in December last year, so we were not in a position to anticipate what was coming. But we, more largely at the OECD, in March, the OECD published its economic outlook for OECD countries and some other G20 countries. And I would say that the assessment that was shared by Matteo and Francisca is broadly in line with our own projections. The fact that the conflict and the energy shock, if protracted, will have severe consequences on an already fragile recovery, and that this will be particularly challenging for developing countries and emerging economies, given their high reliance on energy inputs. And when we speak about India, I think that what we may not realize is the significant impact of LPG, the gas, which is used in cylinders for cooking, and the huge disruption that the price increases is generating for households in the country. So what I would like to say a couple of words about the report. This is the flagship OECD report about Southeast Asia with perspective on China and India. We have been publishing it since 2010 in response to a request from our member countries to deepen our engagement with the region. The last one, as you can see, focuses on disaster risk financing, but in the past we have covered other important challenges of for the region. As I was saying, our assessment of the macroeconomic conditions that was produced before the Middle East conflict aligns with what was said by the previous speakers, notably the fact that emerging Asia, which comprises the 11 ASEAN member countries plus China and India in our definition, was entering 2026 on a very strong footing, led, as Francisca said, by India. In particular, India, Indonesia, Vietnam, and Philippines were the countries that were really growing very strongly and where we were seeing the strongest opportunities. We were also observing excellent pickup in regional trade, also as a response to the need of diversifying supply chains and to foreign direct investments. What we now see is a situation where, in addition to trade fragmentation and tariffs, the energy shock can bring us closer to what Matteo defined as the more pessimistic scenario, with inflation going much higher than what we had originally estimated, and this mostly through the channels of energy imports and fertilizers that Francisca very nicely explained. So why a focus on disaster and disaster risk financing? Well, the key message that our report conveys is that emerging Asian economies should invest more in treating disaster risks as a systemic macroeconomic risk, and not only as a humanitarian or climate-related aspect. And that in so doing, while there has certainly be an important improvement in the regulatory frameworks and in the range of instruments that countries in the regions are deploying to address this problem, we believe that there is still significant room for improvement in deploying a more comprehensive strategy that combines both ex-ante instruments for financing disaster risk, as well as ex-post instruments. And when we discuss about ex-ante, we refer to issues such as insurance and reinsurance, as well as regional risk pooling, parametric insurance and catastrophic bonds, and other types of contingent credit lines that I will describe in a second. So why is this a problem? As you can see on this chart, if we look at the frequency of disasters of different nature in the region over the last 75 years, you can clearly see an increase in frequency for the region starting from the 2000s, with floods becoming very frequent. But more importantly, as we can see on the next chart, it is the economic costs related to these disasters that are increasing. What you see here is periods of 15 years and the $1 billion total disaster-related damage in the region. And as you can see, over the last 15 years, 2010 to 2024, disaster costs have gone over 600 billions, in the range of 700 and something. So if this is a problem because it creates economic costs, we should look at not only at the output and employment consequences of this, but also at the implication for public finances, financial stability, and the longer-term development prospects. And within the region, of course, there is a lot of heterogeneity. So if you look at the incidence of the cost, it's clear that lower-income countries suffer the most severe losses in relative terms. But when we look at more advanced economies, including India, we see that due to very high urbanization, these countries are increasingly exposed to the risk of disasters because of asset concentration in disaster-prone areas. So what to do to cope with this situation? In this chart, we summarize a number of options that are generally recognized in the literature about disaster risk financing, both in terms of ex ante, so before a disaster strikes, and ex post, after the disaster has happened. And you can see on the left-hand side the different type of mechanisms in terms of risk retention, risk transfer, using external donations, and more general options that are related to domestic revenues and taxations. So what we have documented in the report is that across the countries of emerging Asia, there are a number of tools that have been put in place, and we described those. But what we also observe is that traditionally, emerging Asia has been relying predominantly on ex post financial mechanisms, such as budgetary allocations, emergency borrowing, and ad hoc donor assistance. The problem with this approach, which is, of course, it's important to have ex post, but the problem with this approach is that it can be relatively slow, unpredictable, and more costly in coming to addressing the consequences of disasters. And this is one of the key messages that we put forward in the report, that we need to move in the region toward a more balanced mix of DRF tools that combines both ex ante pre-arranged responses with ex post financial responses. So what we do in the report is that we explore the relative importance of different tools, such as I said, insurance and reinsurance, the development of regional risk pooling, the adoption of catastrophe bond and parametric insurance, where parametric insurance is basically a type of insurance where there is an automatic trigger and disbursement of funds irrespective on assessing the damages, and also the development of contingent credit risk that are often developed with multilateral development bank and regional development bank that implies pre-arranged loans that can be accessed contingent to a certain event happening, so with a declaration, for example, of a disaster. One important point that we are making in the report is that DRF, disaster risk financing, must be embedded in broader public financial management and disaster risk management frameworks. And we have looked at how different countries are doing that. And so here you see on the screen the specific case of India, where, as you see, according to one measure of risks, there are several, but let's say this one is the World Risk Index 2025. India ranks second after Philippines in terms of the most vulnerable countries globally. And when we look at sorry, yes. Did you say something, Sergio? No? Okay, sorry. And when we look at the type of tools that India is deploying, India combines a strong ex post financing mechanism with also some contingency budget provisions. What we see in India is that despite a relatively more advanced approach than other countries in the region, there are still a number of challenges. First, common to other countries in the region is the reliance on ex post responses. Second is that there are significant protection gaps for households and small businesses. And thirdly, being a union state, there are coordination challenges between and across states. So for these reasons, India has also started exploring the use of other tools, ex-ante tools, such as parametric insurance for risks such as floods and droughts. And this is, of course, an encouraging approach. Now, let me conclude with some of the messages of the report, and then maybe share a consideration about the situation related to the crisis and energy. What we see in the region, as I said, is that East Asia has entered, emerging Asia, sorry, has entered this period on a relatively solid foot. But at the same time, the fiscal pressures are quite strong, and the fiscal buffers are tight and being eroded. In this respect, probably India stands out as the country which had accumulated the largest fiscal buffers through relatively prudent policy. But because of the current situation with energy imports and the need of supporting vulnerable households when confronted to the energy crisis, these fiscal buffers are becoming tighter and tighter. But when we look at other countries in the region, they have entered the period with much tighter fiscal conditions due to higher interest payments, growing spending needs, and growing contingent liabilities linked to disaster and state-owned enterprises. So what we are seeing is a combination, I wouldn't call it a perfect storm, but a combination of, on one end, tightening fiscal buffers because of the reasons that we discussed, and increasing needs related to more frequent and more damaging climate-related disasters. So I think that this is one of the reasons why we are encouraging the countries in the region, including India, to take a more macro approach to disaster risk financing, making disaster risk financing a core part of macroeconomic considerations, and in particular, advancing on four key challenges. One, the need of strengthening regulatory frameworks and institutional capacity. I will not go into the details of this, but in many cases, legislations and institutional setup in the countries are outdated, and they limit the actual implementation and operationalization of domestic disaster risk financing tools. Second, the tools that are being used to addressing the problem remain quite limited, and as we have seen, largely focus on ex post measures. And in this respect, we encourage the countries to broaden the options and look at more ex-ante tools. Thirdly, there is a question related to disaster risk finance education, but also to the broadening of data and modeling tools that remain in many countries still insufficient. And fourthly, a very important aspect of strengthening the regional cooperation in disaster risk finance. Now, let me conclude with a general point related to the current situation with energy prices. As someone said, the crisis might be an opportunity because countries are increasingly realizing the risks related to climate change, the financial risk associated to climate change, and also the risk associated to energy dependency. And clearly, this can be an opportunity for pushing forward certain reforms in the area of energy subsidies. And in this respect, I just want to flag that we have done here at the OECD Development Center some work that might be quite relevant for the region, related to the distributional consequences of energy subsidies, and where we were able to model alternative scenarios, in particular the fact that by reducing energy subsidies, governments could free up resources that could be used to better target vulnerable households through social protection mechanisms. So I think that this is clearly a very difficult situation, but it could also be an opportunity on one end to advance with decarbonization and energy security by reducing dependence, and on the other hand, to address a source of fiscal concern, which is the growing burden that energy subsidies are placing on the fiscal account without necessarily targeting the most vulnerable. So with this, I will conclude, and I will thank you and look forward to the conversation after the presentation.
Great. So let me mention that we have published a paper on the role of climate change in the perspective of the perspective of geopolitical role of India. You can find it in our webpage. Now let we turn to the discussion with our great discussants, and I will ask all of you to try to stick to the 5 minutes because we are running out of time. First of all, Japan, you have a perspective, institutional perspective on this report and an experience from different point of view. Please, I'm sure you have interesting comments to make to this report.
Okay, thanks a lot, Sergio, and thanks a lot to the host, Cespi. And first of all, let me praise the speakers, Francisca, Matteo, and Federico, and their respective institutions, because the wealth of information they have provided and the wealth of assessments they have provided is indeed remarkable. So I will try to do my best in keeping up with the standing of this report. I would like to comment around three pivots. First, the assessment of the shocks, the current shock deriving from the Middle East crisis. Second, about what other possible shocks can impact on the world economy and on Southeast Asia in cascading. And second and third, on the need to build resilience where at those times when it is lacking. On the first aspect, let me say that the analysis provided, these are depicted basically a textbook case of a supply side shock having stagflationary effects. This is quite standard, and unfortunately, as I would say afterwards, this is a very difficult kind of shock to be countered by policymakers. However, the strands, the ramifications of this shock are very important and differentiated. And more than that, I would like to touch upon the fact that, of course, we have to focus from a policy perspective on a forward-looking approach, and so most particularly on the possibility that there could be second-round effects vis-à-vis the obvious standard effects deriving from the initial negative impact on growth and positive impact, positive in the sense of rising inflation deriving from higher energy prices. So the perspectives which were touched by the speakers were, of course, starting from the energy markets. Here, I would just reinforce the concept that even if the conflict stopped now, we would feel the effects going forward for quite some time. Both for political reasons, but also for the reasons that Matteo was recalling, that the damages to infrastructure are such that they need time to be repaired and to restart the fossil fuels flows from the Gulf. So this is one element that leads us to think that there could be some persistence, some second round effects reverberating over time. Also fertilizers, Francisca talked about this. Their affordability and maybe even their availability, and this is valid. This is a valid point also about fossil fuels, because it's not only a matter of affordability, but it's also a matter of availability in some instances. Means that, as Francisca was saying, the problem is not for this harvest, but for next harvest. And I suspect that fertilizers not being available or affordable now, the next harvest will not be as good. It was, Francisca was saying, we have the storages that we fill the gap, but again, I pose it as an item for discussion. Thirdly, logistics, transport corridors. Here, let me just say that I doubt that freight costs will go down swiftly to pre-crisis level in a relatively quick period of time. And I would add to that aviation is suffering from a lot of turmoil, and Southeast Asia is maybe at a disadvantage, especially in connection with the Asia-Europe routes. That there is a need probably to reroute certain flights. The Middle East hubs may not be at full capacity or even available for quite a long time, so that could be a problem. And finally, I will mention financial conditions. It was said that especially what happens in advanced economies reverberates in emerging Asia because, of course, the risk aversion of international investors may lead to outflows from emerging Asia. And I hear that, if I'm not wrong, even India in particular has suffered from such outflows also in the first part of this year. And this could be an effect that reverberates across time. What other shocks could be experienced? Well, again, they were mentioned, maybe not specifically as shocks, but I'm talking about trade policies and climate events. On trade policies, I am afraid that we are not at steady state because a number of trade arrangements and deals are temporarily suspended, and we don't know what will happen at the expiration of this moratorium. And so the scenario is unpredictable. However, the current pragmatic ways to approach this issue, like the India-European Union trade agreement, provide a great space for thriving from trade, which, as a liberal economist that I am, I believe it is certainly to be pinpointed as a key driver for growth and for technological advance. Climate, I mean, the OECD report, I think, but also the others, provides a picture whereby extreme weather events are multiplying over time, and so there is a need to devise the disaster risk finance approach. And here I'm starting to go into building resilience, starting from the climate issue. Under the G20 presidency, Italy who tried to push this work on disaster risk finance. And I think here there is, I would just pick up on 2 points on the OECD report. First, 1 point on regional cooperation, which is, I think, a point that stands out for all issues in all matters. The more we act cooperatively, the more effective we can be. And then on ex post financing as opposed to ex ante financing. And here I would like to point simply to a political economy consideration. It's not only myopia, I think. It's also the fact that ex post it's sometimes easier to mobilize support for extreme weather events as opposed to ex ante. So I agree with the need to reinforce these second ways of working. Going further on building resilience, first we have to ask whether we can build resilience faster than we consume it during shocks. I don't know, but we must we must try to meet this challenge at the most. And of course, this requires not only a number of policies to enhance preparedness on a number of fronts like energy, diversification of sources of energy, including renewables, financial conditions, keeping the house in order not to lose the attractiveness of international investors, but also resilience must be a transversal concept, taking into account also distributional effects. And here, I think the World Bank report goes into that quite neatly, because of course we cannot leave vulnerable firms, vulnerable households behind. They must be somehow supported. As it was recalled by others, the interventions should be targeted and temporary. But again, here there is a political economy consideration that once you put in place a temporary support measures, withdrawing it is certainly very, very difficult. But this must be done in order to provide income support as opposed to maybe energy subsidies, which might be counterintuitive in the sense of inducing people to consume more energy than otherwise. And they must be designed in a way to minimize fiscal, to maximize fiscal sustainability perspectives over time. And by way of time, I would stop it here.
Thank you, Gianpaolo. Thank you very much. Now let's move to Pasquale Scaramozzino, that has been is a co-author of also with other two Indian economists of a very interesting paper on the value chains, global value chains, and the position of India in global value chains that may be useful to refer to today. You will find it in our website. Pasquale.
Thanks. Yes, I'm trying to connect. Yes, I think there it is. Yes. Okay. Okay, so thank you very much, Serge and Danielle and HFP, and for inviting me to contribute to this discussion. Yes, I'd like to make some short points, simple points, really, and I shall unapologetically focus on India. And I will also try to bring a little bit, if I may, more CHESP perspective on this. So I will look at some papers, some results, which we have found through some analysis of especially trade in India. So we have seen that the world economy has experienced huge shocks to global trade in the past couple of years. First of all, the US tariffs started being imposed at the beginning of 2025 with extreme uncertainties and big chaos, really, in global trade. And more recently, the Middle East conflict, which also is having huge disruptive effects on trade. So these large shocks clearly will lead to a redirection of global trade flows. Global trade flows are not static. They will change, they will evolve. And whenever there are difficulties, they will redirect. So what I try to do in this presentation, try to be short presentation, is to look at the position of India in global trade, mostly look at where it is or where it was before these shocks, and possibly the vulnerabilities of India in this sense. And this could also, I think, help motivate why India is quite so keen, quite so highly motivated to enter trade agreements with other countries or group of countries. So I will look at the position of India in the global value chains, then the centrality of India in global trade flows, with particular reference to Asia, look at problems posed by the exchange rate, and then issues related to climate change and the ecological transition. And all of these points build on issues or topics that have been already mentioned by the previous speakers. I'm trying to move forward. Okay. So first of all, global value chains. Here we look at the pattern of import and exports in the countries, and the backward and forward linkages, as it were, in trade flows. And in the literature, a distinction is usually made between backward participation and forward participation. Backward participation refers to the extent to which domestic production relies on imported intermediate inputs. And it's usually believed that the consideration in the literature is that backward participation tends to be a characteristic of labor-abundant developing economies who specialize in assembling activities depending on imported inputs. Forward participation, by contrast, looks at the domestic value added, which is embodied in other countries' exports. So they look at the role of a country as a supplier of intermediate goods and services. And this is most typical of advanced headquarter economies. These are capital and knowledge-intensive economies which specialize in designing, branding, and more generally, high-value component prediction. So how is India faring in terms of backward and forward participation? And as Sergio mentioned, conducted a study with Anwesha Basu from Pune University, Partha Sen from Delhi University. Partha Sen is also a member of the Observatory on India. And there we found that India only has a limited integration into global supply chains. The manufacturing participation of India is actually dominated by backward linkages, and more recently experienced a decline in forwardness and increase in backwardness and two-sided participation. This is especially true for network products such as electronics and machinery. There is, however, a high forward participation in services, so services are possibly the bright spot in terms of the global trade in India. Tariffs seem to be negatively correlated with the backward global value chain participation, so the reduction in tariffs could be, in this sense, beneficial. But we also notice some vulnerability, high dependency of India on China inputs. This dependence has increased. And this figure just shows the changing profile of backward and forward linkages. And with specific reference to the manufacturing sector, we looked at a variety of sectors in the economy. These pictures only look at the manufacturing sector. And again, we can see a decline in forwardness in the participation, again, dominance of backward services. And this is a comparative analysis, actually, of India with a number of Asian countries, including China. China, by contrast, has exhibited a large rise in forwardness, and therefore this puts China in a better position in terms of international specialization of trade flows. Okay, but how central is India in global trade flows? So what is the strategic importance of India in Asia, or more generally in global trade flows? And this analysis has been carried out with a colleague of mine from London, Yagane Hillington, and then we use some tools from network analysis. How central am I in a network? How important am I in a network? That depends on the links I have. So if I'm linked to all of you, as I said, enhances my force. But in turn, my importance depends on the links that you have. So if you have many links, that also enhances my own importance and own centrality. And I would be one of your links, so there could be some referential aspects in this. So we try to use these tools from network analysis, which try to establish the centrality of countries, of nodes in this network, in terms of the links which they have established and of the intensity of the links. And here we use exports as the key measure to assess the intensity of the links. So these are not measured from social network analysis. The particular measure we use is a Katz-Bonacich centrality measure, which is based on the bilateral trade metrics, import and export, so each country with every other country in the group directly. So we distinguish between exports and imports. And if we look at Asia, we can identify a number of core countries, and these include China, Japan, Vietnam, Hong Kong, Singapore, Indonesia, and Malaysia. India does not belong to this core group of countries, but rather belongs to the outer ring. And yes, it is a graphical illustration of this network. So we have the core countries in the center, and India is further to the left, to the bottom left. So it's in the outer ring. So in terms of its exports, it's not in a central position within Asia. And possibly this helps motivate the urgency by India to establish agreements with large groups of countries, with the European Union, with the UK, with New Zealand. So presumably, because there is a lack of centrality of India in the network, it is particularly pressed to establish agreements in order to improve its position. Now, this figure to refer to 2023, so before the current crisis. So presumably, since this data were available to us, the situation has already changed. And certainly in a few years' time, we'll see the results of this redirection of trade links and establishment of links with the key world players. Now here we also relate the measure of centrality to measure the vulnerability to trade. So in this diagram on the vertical axis, we have centrality, which we have already on the previous graph, and China at the very top. So China is the very top country in terms of its role in world trade. And on the horizontal axis, we have a measure of vulnerability. And what we have used is the Hirschman index of concentration of X. So on the horizontal axis, we measure how concentrated the exports of a country are. And we can see that the most vulnerable countries are Mexico and Canada, because of their heavy reliance on the United States. And presumably the countries were the most affected by the disruption of trade and uncertainties of Paris and everything else with the United States. So Canada and Mexico are highly vulnerable, very much to the right on the horizontal axis. And India is quite at the bottom left. It's not very center, but not particularly vulnerable. Okay? And so presumably, the vertical dimension will increase following all these trade agreements. So India will take a more central position in global trade. Hopefully, it will increase its diversification, so it will remain relatively less vulnerable in terms of global trade. Okay, another issue which has also been mentioned by Matteo, by the other speakers, is weakness of the exchange rate position of India. And this graph shows the exchange rate between the Indian rupee and the US dollar. And we have seen that India has experienced a very systematic and persistent trend towards the depreciation of the currency. So in the Indian rupee has lost value to the US dollar and to most other currencies. And this poses some important questions. So why has this happened and what the possible consequences would be? And it looks as if one main difficulty is the inability by India to attract foreign investors. And this has been mentioned also by Gianpaolo just now. There have been large net outflows of both foreign direct investment and foreign portfolio investment. Portfolio investment are particularly volatile. They respond very quickly to changes in interest rates and is affected by investors' flight to the dollar, but also higher cost of energy imports. And Matteo has explained how important the cost of energy is for the balance of payments of the of India, and also punitive American tariffs. And if the current conflict in the Middle East is not resolved, it's possible to anticipate further depreciation of the rupee, which will again be in principle could improve the international competitiveness of Indian exports, but could be a problem, could make imports more expensive, could lead to imported inflation. It could be politically a sensitive issue. Now the current government has made a big deal on the strong rupee, and so it could be embarrassing for the government if the rupee were to depreciate further, relative especially to the And finally, just a short comment on the ecological transition. And I would like to refer to a research paper that has just been published in one of the leading environmental economics journals, Ecological Economics. One of the authors is Partha Sen, who is also a member of our observatory, together with Adrien Fabre from Paris, Rick Vanderpleij from Oxford, and other authors. Now, the disaster risk finance and extreme events, and these are enormous issues. And now, if we look at why extreme events are much more frequent now, and really even relatively small changes in average conditions could lead to a much larger increase in the frequency of extreme events. Now, if we think of a distribution, for instance, of temperatures, extreme events are associated with the right tail of the distribution. Okay? So they're very rare events. We think above a certain threshold, we are likely to observe rare events. Now, if there is a small shift of the distribution, a small increase in average temperature, this would have a disproportionate effect on the events at the very tail. So the frequency of events beyond the threshold would decrease several folds. So even modest increases in average global conditions could lead to to very dramatic increases in the frequency of extreme events. Okay? From rare, they become much more common. And so the issue with Partha Sen and the other colleagues addressed is how to share the burden of transition. There is no global north, global south, global north overwhelmingly responsible for pollution since the Industrial Revolution. So how do we share the burden more fairly? And they devised a possible strategy which would be consistent with the principle of common but differentiated responsibilities and respective capabilities. Based on an idea of a coalition of the willing, we have seen a number of coalition of the willings recently. Due to be on a purely voluntary basis, willing countries could form a sustainable unions. They could contribute financially in a way which is proportional to their income, to their gross national income, and they would receive transfers and emission rights proportional to the population size. So it could be efficient from the point of view of economics, but also relatively fair. And this tool, this strategy could be based on carbon pricing, new taxes on wealth, on the very rich, have been proposed by a number of authors, on the polluting fuels and on corporate income. Now, most revenues would remain within the participating governments, so they would still have agency on the use of these funds, but a defined share would be pooled internationally to be based on a voluntary cooperation by countries, and it could be believed to be idealistic, but according to the author, there is increasingly support by the public in a number of countries which recognize the urgency of addressing the issue of the ecological transition. And so that concludes my intervention.
Thank you, Pasquale. Now we have the opportunity to have the point of view of an Indian economist, Siddhartha Mitra, who is collaborating with the observatory. Is from remote. Siddhartha, please. The floor is yours.
Okay, thank you. And I'll be very brief. I think, there's already a deficit as far as time is concerned. And I hope to, contribute some sort of a surplus from my slot. First of all, thank you, Sergio and Daniel, for having me. This is semester time, so a lot of teaching is there, and I haven't been able to prepare as much as I usually do. But in any case, during this intervention, I will be quite short. When we talk about AI, I will expand more. To start with, there were three very good and energetic presentations by Francisca, Federico, and Matteo. I will not, take up these presentations point by point, but what I will do is I will dwell on a few things. First of all, disaster risk finance. Now, my question is, if we are so hung up on disaster risk finance, shouldn't we bother about disaster prevention? Okay. And as a person living in a developing country, let me point out that development in a developing country is often unplanned and impulsive. Okay. And that is a ready recipe for disasters. In 2025, we had this massive disaster in Uttaranchal, and it was blamed on having too much development in a hilly area. I went to Darjeeling 2 or 3 years back, and I was struck by how people had built rows and rows of hotels on slopes. Okay. And the bazaars were crowded and all that. So, this kind of development has a trade-off. Okay. A mere growth rate is not enough. Okay. And I blame the West slightly because the West is also hung up on growth rates. Okay. If you look at, Francisca's presentation, I think she said that India is the bright spot because of trade reforms, and I totally agree with her. They've very energetically pursued these trade reforms. But what they have also pursued very, energetically and often at great expense to the environment are big ticket commercial projects. For example, the rupees 72,000 crore Great Nicobar project. What is happening there? They are going to fell 10 lakh to 10 million trees. Okay. And this will threaten 160 square kilometers of pristine forest. And what will we have in return? We'll have a power plant, we'll have quite a few roads. Okay. Typical modern day development. Okay. That's the trade-off that you are seeing. And you see, the thing is that you cannot keep on pushing nature. It's ultimately going to rebound on growth. Okay, so one needs to be, cognizant of that. Let me see. Now, if I look at this, the conflict in the Middle East and, India is importing 85% of its crude oil requirement. And obviously, what this has done, the surging price of crude oil has done, it's pushed up India's import bill. Current account deficit, I believe, has gone up. And government finances have been strained as the state has tried to absorb some of the burden of the price shock. And this is done in India, there are massive fuel subsidies. Somebody said that there should be cash transfers, but in India, there are always massive subsidies in regard to crude oil. And one has to point out that obviously there is an increase in government expenditure because the subsidy bill is increasing. What happens as a result of this? It seems that social sector expenditure as a proportion of the government expenditure is at an all-time low of 17%. Okay. Now, these rising crude prices, somebody said that India is doing quite good as far as inflation is concerned. I believe I saw the latest April data, and I believe that, inflation is rising in India. So that will increase the prices of consumer goods. Now, if the prices of consumer goods do increase, then RBI might have to follow a tight monetary policy and rate cuts, and that would slow down economic growth. Okay. Now, I must point out two silver linings though here. One is due to the rising crude prices, there are some state-run oil and gas companies, ONGC and Oil India, which will get financial gains. The other thing is that because, India purchases, 85% of its oil supply from abroad, the increase in the subsidy bill has been significant. So what the Indian government is doing with the help of the private sector, it is trying to roll out on an emergency footing piped natural gas networks, and it is also trying to effect a faster transition to renewable energy. So this 1% cut in the short run, okay, due to the conflict might be traded off against a longer run increase in growth, okay, increase in economic growth. All very good, but as I'm telling you, these growth figures hide a lot of things. You have to look at the social sector expenditure. You also have to look at the environment. You have to look at the occurrence of disasters. All of these are related to pursuing very, very sort of dedicatedly a pro-growth strategy. Thank you.
Thank you.
Can't hear you.
So the second round is on the number of challenges and the World Bank has focused on industrial and there is a lot. You hear me? Remote, do you hear me? Now you hear me? Yes. Okay, so I said we stick in the second round on just on the main messages. Please, Federico. Usually the final slides. And we start with Francisca, the World Bank economic update. There is a chapter industrial policy and jobs, and within this chapter there is a box that focuses on the impact of AI on hiring and jobs. So we start from here.
Thank you. And don't worry about the slides. I've got lots of slides, but I won't talk to them. I'll give you 5 facts. AI is sweeping through the labor markets in South Asia. It's like the petri dish of what's happening, and it matters in South Asia because 1/4 of exports are ICT, communication technology, basically the AI exposed sectors. So just to give you an idea how fast it's sweeping through the labor market there, we've got millions of observations of hiring data, job postings. In those, there is a 30% wage premium for AI skills. 30% right now, already existing. So by the time governments rumble into action with skills programs, it's way too late. These people are already finding their ways of acquiring AI skills because the economic incentive, the wage incentive is so large. So there's very rapid adoption. You're also seeing the destruction. It's leaking to some types of jobs. It is a labor-saving technology. So in aggregate, for anything that is exposed, there are job losses. So the occupations that are exposed are seeing about 10-ish, just so in low double-digit % declines in hiring. But exposed can be exposed in 2 ways. Can be substitutable exposed or can be augmenting exposed. These aggregate losses of low double digits are happening in the substitutable exposed jobs. Much more. There we're seeing 20-30% declines in hiring. We don't see the firing, but we see the hiring losses. So that first phase of destruction in jobs is very clear. Now it's beginning to emerge. That's the interesting bit, is the adaptation. You see in firms, so now we're moving to firm level, not occupation level. Again, the most substitutably exposed jobs are having the largest declines, significant declines in hiring. But what we're seeing is that the firms are now increasing their demand, their hiring, their job postings for workers with AI complementary skills. There's a significant increase in demand for AI complementary skills. It's beginning. And that pivot is strongest among local Indian firms that are providing services for foreigners. The multinationals in India, they're actually not conducting that pivot as strongly. It's not significant. It's the local firms that are supplying, that are sort of the Infosys, it's the Reliance, it's the local firms that are working in global supply chains that are making this shift now towards AI augmenting firms. So we're seeing the job creation in that bit. The final thing that we're seeing, the 6th factor, if I may, is a massive increase in exports. So for now, the disruption has been in labor markets. The pivot has been in labor markets. It has not set back services exports. These ICT exports are continuing at a pace of 30% increase since the introduction of ChatGPT compared to 10% in other services exports. So there's your productivity gain. And with that, back to you.
Thank you. Great. Francisca. Matteo, same. There is a chapter in the Asian Development Outlook dedicated to preparedness and economic impact. Can you give us the main results?
Yes, I'll try to be quick. So this is a special topic in ADO. So we look at this, so it kind of complements Francisca's picture. So we look at this from a macro point of view and from the lens of AI readiness and adoption. So for readiness, we start with a diagnostic, and basically we kind of take a picture of the different degree of readiness for artificial intelligence using this index developed by the IMF that looks at 4 different categories.
Go to the results.
Infrastructure, human capital, and innovation and regulation. Main result here is that advanced Asia in the Pacific is much more prepared than developing economies in Asia. Mm-hmm. Then we run a number of scenarios, and essentially the key results here are that adoption of artificial intelligence could boost advanced Asia and the Pacific's growth, depending on this scenario, 0.6 percentage points to 2.1 percentage points. These are data for 2030, 2040, similar numbers. much lower impact on developing Asia and the Pacific. Again, it's a question of being ready and being able to adopt AI. When we look at the different sectors, no surprises there. Services show the most significant gains. AI can boost, digital analytical activities, and that's the typical activities that you find in the services sector. Much less for agriculture and industry, at least at this stage. And obviously, in developing Asia, you find production structures which are much more based on agriculture than services, and especially the kind of services, finance, education, and so on. Jobs, again, we find significant differences between advanced economies and developing economies. Advanced economies, we find much more complementarity, and so boosting productivity and creating jobs than we find in developing economies. And finally, given all that, the policy recommendations are, first of all, try and build the foundations for AI adoption. So invest in digital infrastructure and human capital in an innovation system that is the right one to adopt AI. Leverage services activities, integrate into GBCs to produce AI enabling goods. And finally, there is going to be a cost to this transition, and try and prepare workers with training and try and build a social protection system that is going to help kind of smooth out this transition to AI. That's it.
Perfect, Matteo. Great. So our aim is also to encourage you to read the reports. They are full of information and interesting analysis. You just had a picture of what they are. Federico, this is your turn now.
Thank you, Sergio, colleagues. So we are currently undertaking research to assess the impact of automation and artificial intelligence on developing economies across the world. And we have a particular focus on the impact that these two trends, automation, artificial intelligence, will have in particular to informal workers. So the results are still being produced, so I will not be able to tell you in detail what the final answers will be. But what we observe is that when we look at emerging economies and developing countries, 1/3 of workers currently holds a job that has considerable traditional automation risks, which is slightly more than what we observe in the OECD, where this is about 1/4 of the workers. When we look in particular at informal workers, they are twice more likely to be automated than formal workers. And the risk of traditional automation in our cross-regional work varies across regions. And we find that workers in Asia are the second most exposed to automation after Africa, but before Latin America and Europe. So clearly, the challenge, especially for informal workers, will come mostly from automation of manual tasks that will be replaced by technologies and robots. But still, as colleagues were saying, generative artificial intelligence is also likely to impact the, let's say, more white-collar or more higher-skill profession. So why is it important, and I will conclude on this, to understand this profound transformation in the labor markets and the impact on informal workers? First of all, because informal workers in many countries, including Southeast Asia, represent a very large share of the workforce, but also because the shifts in tasks and skills go hand in hand. So governments need to prepare workers for the new tasks that will not be automated, or for the tasks that will be facilitated by artificial intelligence. And so what we're looking at is also the implication for skills policies and for the education and training system in general. So I will stop here and give you back the floor, Sergio.
Thank you, Federico. So let's start the discussion with Siddhartha, who has published, as I mentioned, a paper on the impact of artificial intelligence in India. But of course, I have to ask you to be proportional in your comments to the synthetic approach that the speaker has. Please, Siddhartha.
Yeah, I would like to ask for the 2-minute surplus that I gave you last time. Yeah. So, to start with, there are, robots and human beings are both substitutes and complements. And substitutes in the sense, robots are much better at processing data, at detecting patterns, okay, and in doing mechanical jobs. So in that sense, robots are going to displace human beings. But on the other hand, humans have a massive advantage in communicating and discerning complex emotions, thinking critically, and making judgments where concrete data is not available. So that is the kind of specialization that we are looking at. Um, uh, Robots powered by artificial intelligence, doing these mechanical tasks, processing data, highlighting trends, and human beings specializing in emotional communication and making judgments and all that. That's the kind of long-term trend that we are looking at. And, in 40, 50 years' time, the world will sort of settle down to this division of labor between human beings and robots. Okay, but I must point out that there is an effort to make robots which are just like human beings. So, I might well be wrong. Okay. Now, as far as India is concerned, the Indian government has done a lot to harness artificial intelligence. Okay. For a developing country government, it has really done a lot. And there are areas in which artificial intelligence hasn't been harnessed to the right extent or to the desired extent yet. But if you look at, for example, if you look at rural areas, and there is problem with absenteeism of teachers, non-availability of books, infrastructural problems, and here, AI can be used to provide personalized learning experiences for children that will help in human capital formation. Right now, I don't see a big effort in this regard. Artificial intelligence can also be used for dropout prevention using socioeconomic data and test scores. Now, where artificial intelligence has been used a lot in India is in provision of healthcare services. And again, there's this problem because of living conditions in rural areas. You don't have doctors going there. So instead, you have the Indian government has introduced teleconsultations. So eSanjeevani, for example, is a platform that has surpassed 100 million teleconsultations in 2023. Now in agriculture, the Indian government is doing quite a bit. Farmers are being provided technical advice through the Kisan Mitra chatbot. You know that AI can be used to optimize the application of fertilizer, pesticide, and irrigation, and that too will happen with the help of Kisan Mitra chatbot. Now, in regard to the compilation of data on agricultural assets and cultivation by farmers, the Indian government has launched a digital agricultural mission, okay, in 2024. It will also give data to farmers on soil, weather, and data sources. Now, there is the smart grid mission in India, which is trying to reduce the T&D losses. Historically, transmission and distribution losses in electricity have been as high as 20%. They're trying to bring it down to 6 to 8% by better matching supply to demand. Another important area in which work is being done is by having an AI-powered intelligent transport system. So what is happening is economic growth is happening, cities are growing, but Indians cities are heavily populated, so the road space is getting congested. So there's a natural decelerating impact on economic growth. Now, what this intelligent transport system will do will actually smooth out the traffic flow and help remove congestion. There are improvements in the financial sector. A lot of financial development services are being given using AI. In tourism, we expect to see robots taking over things like interaction with guests so that human beings can be employed in personalized travel planning, event coordination, and concierge services. Research and development will be more and more taken over by AI. And as I said, they're better at processing data and identifying patterns. So research and development in India should really take off. And, you know, this particular government is very, very keen on AI. Even its own political campaigns are run using AI. So it's very, very AI happy government. Now, and, you know, there are very important regulatory and governance measures being taken. There is the Information Technology Act was launched as far back as 2000 to cover cybercrime, e-commerce, and electronic communication. Then principles for responsible AI have been given by NITI Aayog, which is the premier think tank in the Indian government. Information technology rules were implemented in 2021, and this is very important to enhance accountability from digital platforms such as social media, OTT services, and digital news providers. So in a sense, you know, the media is being quote unquote monitored a little bit. Now, I've given you a fair sense of what is happening in India. There are measures being taken to harness the economic impact of AI. There are also regulatory measures being undertaken, which is good, very good for a developing country. And what about economic growth? Now, in my paper, which Sergio talked about, we worked out that if India is to achieve high income economy status by 2047, it has to grow at 7.951% per annum. And right now, we are looking at a growth of 6.5%. So can AI lift the growth rate by 1.451%? That was the question. Okay, and there was a work by Accenture which says that AI can raise GDP growth by as much as 1.3 percentage points, and the channels were greater profitability in manufacturing and innovation in retail. Now, ICRIER did a very detailed study, and basically what it said was that if AI intensity, which is the ratio of investment in AI to sales, goes up, that pushes up total factor productivity, and that has a major impact on gross value added. Now, what they worked out was that a unit increase in AI intensity would increase GDP by 2.5%, but a unit increase in AI intensity doesn't happen every year or every 2 years even. Okay, so one can, however, say that if there is an increase in AI intensity, then the capital stock goes up significantly, and that would provide lasting impact on economic growth. Now, what Francisca talked about, this is the last thing that I'm going to talk about too, which is we're talking about job destruction, and ILO has pointed out that 70% of jobs in India are at high risk from automation, okay, and AI. So 70% of jobs in India are at high risk from automation and AI. And this will negatively, obviously, impact demand and growth. So we need job creation in India, and there are some good candidates for job creation. The hospitality and tourism sector, which is booming because India is growing. Okay. And there is the geriatric care sector, the older adults, the number of older adults in India is increasing quite a lot because of increase in life expectancy. So a lot of labor will be needed in that area. Okay, and lastly, one has to point out that, you know, AI expansion doesn't take place on its own. They are themselves, AI and allied industries are themselves sources of employment. And, you know, this requires higher order creative and cognitive functions from human beings. And one has to point out here that significant recruitment in regard to AI, significant recruitment of humans in regard to AI has been done by Infosys, by Tata Consultancy Services, by Capgemini, by Wipro, by Foxconn. So, you know, there are positive things happening, you know, total factor productivity rising because of AI and sectors expanding. There's also this job destruction happening. And then there is the scope for job creation in the hospitality and tourism and geriatric sector. And there is the scope for human employment in the AI sector itself. So any sort of recessionary impact can be neutralized if one plans carefully. Thank you.
Thank you, Siddhartha. Now, Pasquale, you don't have time credit, but please.
Yes, very briefly. Thank you, everybody, for your presentation. Thank you very much, Siddhartha, for your contribution. Read your paper, very informative, very thorough. Just want to make a couple of points on artificial intelligence, and in particular the business model of artificial intelligence. Now, artificial intelligence engines are voracious users of energy. Could that derail the process of ecological transition? Will it be sustainable in the long run? We have seen already, the disruption caused by the closure of the Strait of Hormuz, and what will be the long-run prospects? I mean, we can see that artificial intelligence companies also have a direct effect on the environment, and they increase the local temperatures where they are stuck. So there are environmental costs. AI companies have mostly expanded their activities and invested by taking on debt. So they now are highly levered, they have a huge amount of debt, and their profits are very small relative to their debt. So is this potentially a financial crisis in the making? Could there be a bubble that will burst? How long is the financial position of the artificial intelligence company going to be sustainable? One further point on artificial intelligence and macroeconomic policy, monetary policy, and interest rates. Now, there have been the notion that has been put forward, especially by the incoming chair of the Federal Reserve, that the increase in productivity made possible by artificial intelligence could lead to lowering of interest rates. But I mean, it's not quite obvious that this will necessarily be the case, because if there are expectations of higher productivity, it will lead to expectations of higher labor incomes, and that could actually lead to a reduction in savings, because if consumers are forward-looking, they will increase their consumption in the expectation of future labor income, so there will be an increase in demand. And similarly, companies will also invest, and so there will be an increase of both consumption and investment that could call for an increase rather than a reduction in the real neutral interest rate, which is used as the baseline for the policy rate of the Federal Reserve. So artificial intelligence could actually lead to an increase in the equilibrium interest rates rather than a reduction. And actually, this is what happened in the early 1990s. Alan Greenspan, to his merit, saw the potential for an increase in productivity in the United States, and his response was to increase interest rates. So a reduction in interest rates would only be possible if the supply side response is faster than the demand side response. But we know that usually the demand adjusts much more quickly than the supply. And
thank you, Pasquale. So Gianpaolo, and then a very short reminder and final message from the speakers.
Okay, well, in the interest of time, I will recall just a couple of concepts, and I will start by saying that the AI is not just a technological shock, but it is only new structural shift, which, if not now, will increasingly overhaul the economic system, and its ramifications are very much differentiated across productivity increase, labor market displacement complementarities, financial systems, as we were hearing, even economic policy making itself. So here I will just recall again something that was commissioned during the Italian G7 presidency in 2024, by which a high-level panel produced a very interesting report in which passed through a number of issues that I've mentioned, and essentially the conclusion was, well, this process needs to be governed. It must not be left by itself, so there must be an adequate governance both in the public sector and in the ensuring that also in the private sector there is an adequate governance. And the second concept is again a piece of work by the OECD that was commissioned by the Italian G7 presidency about the possibility of a digital divide being created between advanced economies and emerging and less developed economies in view of the fact that there are a number of enabling factors in which emerging market economies may be lagging behind. One of that is digital infrastructure, data systems, financial system, and also human capital. I mean, the proportion of white-collar workers working in advanced economies is certainly greater than blue-collar workers. And so actually here, both, given the nature of AI, both are at threat of being displaced. So again, my overall play is let's look at it not in a compartmentalized way, but from mostly from an overall policy angle.
Thank you, Gianpaolo. Thank you so much. There were so many issues, but we don't have time to discuss all of them. Just 30 seconds each to the speakers for what they learned, what the stock take, and their final message. We start with Federico this time.
Thank you. I think that the key message for me is that South Asia and India in particular hold a great potential for the world economy, and we should all invest in knowing more and supporting more India's reform because they will benefit the global economy as a whole. Thank you.
Great. Matteo.
Learned a lot. I agree with Federico that Asia is still the most important engine of growth at the moment, despite the shocks and despite everything else is shown to be very resilient. I think this is what we're going to see going forward. The fundamentals of the region are really strong. And so, yeah, look forward to the next presentation.
Yes,
next year.
Very good. Yeah. That's it.
Thank you. Also looking forward to the next presentation. And watch this space. India is really like a petri dish of all the global events and their impact.
Very good. Thank you so much. Great speakers. You did a very great job and very good discussions. Thank you for coming. Sorry for not having time for discussion. Thank you for joining from remote. See you next time. Stay tuned.